manage your finance. Same way we are going to discuss it. Okay, so generally from company where they receive the money, could you tell me where company generally receive the money, the
From the
financing source?
investors?
Yeah, investor, it means the capital, correct? We say
Yeah.
equity, whoever the shareholder, they are the investor of the company. So there is two type of shareholder: equity shareholder and preference shareholder. Do you know what is the difference between equity shareholder and preference shareholder?
I think it's about the bonds and
No, 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 no,
uh,
no. Okay,
no,
I
no,
will
no.
let. Bond is borrowing. So generally,
Oh,
in a company, there is major source of financing two. One is borrowing. Borrowing, it means you are taking the loan. Okay, either it loan also in, it could be in form of bond. Okay, also it could be in form of debenture. These are just name difference, but nature would be similar. Okay, do you
yeah,
know how loan works? How loan works generally? Any idea about loan?
yeah, yeah.
So what happened? Suppose the company won $1 million. So they will go to the banker and they will take $1 million. For that, the company need to pay the interest. Suppose 10% interest, it means every time they need to pay interest. Okay, the other source of financing, whoever the owner of the company, correct? Whoever business it is, they provide money to the business. That owner, we say equity shareholder. There is different kind of shareholder, preference shareholder. Now what is difference between in these two, I will tell you. So equity shareholder have voting right, means all decision mostly taken by the equity shareholder. They are generally, we say in the term of shareholder of the company. Okay,
Yeah.
preference shareholder also shareholder, but here what happened, they get fixed percentage of dividend. Fixed percentage, it means always be fixed, like 8%, 10% or 12% dividend. If suppose company is doing so good, they are getting profit more than 50%, it all the profit would be related to equity shareholder, not preference shareholder. Because preference shareholder are not taking the risk, equity shareholder the main owner of the company, and they are taking risk. What risk? It could be possible company is not generating profit. In that case, losses would be always equity shareholder. Okay, do you understand the difference between what is equity shareholder, preference shareholder? Why I'm
Yeah.
trying here, explaining here? Because same way you can understand what we are giving, that would be the cost for the company.
Mhm.
Okay, so is it clear what is equity shareholder, preference
Yeah.
shareholder? So they don't have voting right, preference shareholder. Equity shareholder have voting right. As well as you need to remember this, at least fixed percentage of dividend. The company give dividend, suppose if you want to buy Apple company share, you can buy. Okay, and then company will provide. If you buy equity share of Apple company, you become owner of the company. Okay,
Yeah, yeah, I get you.
and then what you will get, if company suppose doing good, they can provide you dividend. That dividend is won't be fixed. Okay, that case is equity shareholder. But suppose you are buying a preference share where dividend always be fixed, 8%, 10% or 12%, fixed percentage only dividend the owner will get it. Okay, now what is cost of capital chapter name? So suppose if company is borrowing money, how much they are paying to the banker, that is nothing else cost for the company, correct?
Yeah.
Suppose if you borrow, no one give loan us free, correct? No one give us loan free. So
Yeah.
the whatever interest you are paying, it is kind of, we can say, cost you are bearing. Why you are bearing cost? because you have taken money from the banker. So that same thing we are going to analyze in what we can say present value factor, tax factor we will apply, and we will see, we'll calculate it. So related all, we will see the cost of capital for borrowing, we will see the cost of capital for equity, preference share, and all the profit. Generally company if generate, suppose growing, they generate the profit. So it always not happen whatever the profit they give to the shareholder distribute. No, sometimes they retain it to make grow. Suppose you have started company with $100,000. Okay, so year one you have done the profit of 50,000. If you withdraw this 50,000, what will happen? The same level your company will go, 100,000, and maybe year two you will earn only 40,000. So what happened? Generally, few years or generally early years, the shareholder or whoever the owner of the company, they don't withdraw the profit because you want to grow your company, and they will use this profit. This profit we say retained earning. If they withdraw it, we say dividend. These terminology, are you clear what is dividend, what is retained earning?
Yeah, sometimes I get lost about it, but
Uh,
I know there is a word like that.
but no, so dividend is distribution of profit. Okay, I'm writing it because this terminology is very important. I think so. Maybe you have missed, or earlier you have done the accounting classes. That's why you didn't remember. But it's very important terminology. Okay, distribution of profit. It means if company distribute, they distribute in the term of dividend. Okay, then retained earning, you can think the profit which is not distributed, opposite of it. Okay, which company applied in their own business only, which is not distributed to shareholder. Is it clear up to here? Or if you have
Yeah,
any question, you can ask me. See, if you understand each thing, you won't forget it. Main reason is behind it. I don't like to, you need to memorize it. Okay. Generally, if you understand, once you will revise, like after my classes, before night, you need to revise and then you need to sleep. Then you will never forget. Okay.
perfect.
So same thing I'm using your professor note. The cost of capital represent cost of financing. So what I have discussed, two source of financing, borrowing and the capital way. And its minimum rate of return. Return means suppose if you are using, means minimum rate of return, how much return you are getting. Suppose to cost is 10%, in percentage term we are discussing, and in anything like revenue you are generating or profit you are generating 12% and cost is 10%, then you will happy to use it. If cost is lesser and earning is more, you will fine with it, correct?
Yeah,
Yeah, then you will, then only you will able to generate the profit. If suppose if it is opposite, cost is 12% and the earning is 10%, then you will lose 2%, correct? So generally
yes.
company want the cost should be lesser than earning. It means earning should be more than cost, correct?
Hmm.
So to identify, once you are aware how much the cost, then only you can check the whether cost is less than earning or not. Correct? That's why this chapter is. That's why it's all about to determining how we will determine the cost. Okay. So same thing they are saying. If we read through it, the cost of capital represent firm cost of financing and is the minimum rate of return that a project must earn to increase firm value. how firm value will increase if earning would be more and cost would be less. Financial manager ethically bound only to invest the project that they expect exceed the cost of capital. Means the whatever the income will come, it should be more than cost, then only it would be beneficial for the financial manager. Up to here we are good.
Yeah, perfect.
The cost of capital reflects entirely the form of the financing activity which we have discussed. Financing activity, two source, and these two source we are talking about long term finance, not short term. Okay, long term means the finance which work more than a year. Okay, long term means the time period would be more than a year, not short term. Okay, now I'll ask this question: what do you think, is debt borrowing good for the company or not?
I think it depends on the company itself or how it work.
Yeah, correct. The question is right. The answer is right. Actually, it depends upon. It's not like sometimes we feel that debt is not good for the company, but uh, a country where you need to pay taxes. Generally, most of the country uh, there is taxes. Okay, so on income, whatever the income you are earning, you need to pay the tax. Correct. So, in case of debt, we get tax benefit. We will see what is meaning of tax benefit. That's why debt is more cheaper than other source of financing. It means debt is better. Then you will only see it. Debt is more cheaper than equity, preference share, and retained earning. Okay, so the mix of both it should require. I can't say okay, just go with debt. No, in that case, if a company just borrowing, that is also not good, because it could be possible they are not able to repay those money. Correct. So it depends upon how the mix you are using, and the mix should be in that manner. Both is good for the company. Bit borrowing also would be there, and other source of financing, equity, preference, or retained earning. Okay, up to here we are good. Are you understanding, or I'm going too fast?
No, everything perfect.
So we will see it how we will get the. So overall, same thing, the most firm attempt to maintain optimal mix of debt and equity financing. It means both should be there. It should be not like only debt or only equity. To capture all the relevant financing cost, assuming most desired mix of the financing, it means optimal, where we are spending less money, that would be more beneficial for the company, and that we will choose overall cost of capital rather than the cost of single source of financing. It means a single source means it's not good, either you are going for the equity only or with the debt only. Both should be there. So this is just showing the source of financing, which I have told you: long term capital and long term debt. We are not discussing about current liability. Okay, it's not here in cost of capital chapter. Here is a example given. So generally we have discussed already, the earning should be more than the cost. Related the example, same thing, the cost. Suppose a firm currently face two investment opportunity. Assume the following: investment A, it's all about investment. The cost is 100,000 and life 20 years, means total you need to spend up to 20 years. Expected return is 7%. If you are investing 100,000 today, you will get return of 7%. Least costly financing available, debt, that is 6%. Means on, if you borrow those money through the debt, you need to pay 6%. What do you think? You will accept this offer or not? This investment A or not?
I think no.
No,
I mean, it's perfect. We can accept it, but it's more
no. So
like
if
6 and 7.
yeah, the earning, suppose, see, if it is new company, whatever earning it would be there, you should accept it generally, and earning is greater than the cost. Okay, if individual, this question I am asking as a so what you should, if earning is more than the cost, you should accept those project. Okay,
But
I
we
know.
don't put bonds and cost together.
No, so see, only this information we have given. We will see later part, but in general, suppose if you don't know anything and the question only are asking about this much, you will say earning is greater than, earning is how
Yeah,
much? 7%. So 100,000 7% also you can calculate. Otherwise, on 100 you can calculate. So 100 on 100 it would be 7, which is greater than the 6. So you would be profit by 1, correct?
yeah,
So you should accept the project. See, generally they are not saying if in this case, suppose it is given situation, in other project you are getting something else, then in that case you will, if it is individual one question, you will say yes. Okay.
yeah, perfect.
Okay, now see, this same question is going to continue. Now in investment B, we are individually checking each, correct? We are not now checking together. That's why answer is we should accept it. Now individually with the B. So what is the question? Cost is 100,000, life is 20-year, expected return 12, and at least costly financing available, equity you need to spend how much? 14%. What do you think? You will accept it or not?
No,
Because here return is less. It means return, expected return means earning is lesser than the cost. So earning is 12 and the cost is 14. You will do loss of 2.
yeah, too.
So you will reject it. Are you understanding why we'll reject it?
Yeah,
Yeah, because it is not good. See, you don't like to lose your money. No one like it. Correct? Whatever, suppose if you are investing anywhere $100, you should get benefited with $100. Correct? The $100 should not reduce by 90 or 80. So that's why we will reject it. Now it could be generally in a company, these two both situation would be available. Yeah, it means investment A as well as investment B. So in that case we follow overall cost of capital. See, this will, what it is given in this will be clear last of the chapter. So I don't want to emphasize it on now, because you will see and you will confuse about it. So we will discuss in later part. Okay,
perfect.
now, so what I have discussed, there is different sources of financing. I have told you that is a cheaper source, preference is higher than debt but lesser than equity. Equity is very expensive. Then after equity, retained earning, bit less expensive or similar you can think. Then preference share is lesser than these two, and equity is least cheaper source of financing. We will see how and why we are discussing it. Okay, up to here we are good.
Yeah, perfect.
So cost of debt. This is starting with one example. Suppose you went a book mela, there you don't have money and you took $100 from your friend to buy a book. Okay, then suppose case one is if you return $100, are you paying any cost of capital in this case? Extra
No,
cost you are paying? No. So
no.
in this case, cost of debt because it is kind of debt, correct? You are borrowing money. Borrowing is
Yeah,
always
borrowing.
so here cost of debt 0. Suppose if you are returning 105, so what would be the cost of debt?
Five
5.
$5.
So $5, how you calculate it? How much extra you have paid, divide by if percentage term 100. So it means 5 extra money which you paid and then amount received. So this is the formula. Interest divide by amount received. Interest divide by amount received. The formula, simple formula for cost of debt when no tax. We are assuming if no tax would be there, interest divided by amount received. If you want, you can write, it is very important, you cannot forget the cost of debt when no tax, interest divided by amount received. Is it clear? Anyhow, I will share these detail what we are discussing right now, but generally important point, you can note it down and it would be useful for you.
Yeah, I'm doing that.
Yeah. So now we will discuss the scenario. So I have told you generally we will get tax benefit. So there is we will see with this example a company, two company, same earning it is there, company A and company B. A company A has loan whereas company B no loan. Means loan means debt. Okay, here it is no debt company. So earning before interest and tax is 1110 in this case. Both the case both company have same earning 1110. In case of company A, because they have loan, they need to pay interest. So they have loan of 100 and 100 ka 10%, at the rate of 10% they are paying the interest. So interest would be 10. In this company there is no loan, so zero interest. So earning before tax 100 minus 10, 100 it would be. In this case 110 minus 0, 110 only. Up to here, is it clear or any confusion? You can ask me any question you
Can we
have.
just repeat the last information?
Yeah. So earning before tax, you understood how we got. Then we apply tax. If the company have the tax rate of 40%, okay, so
Okay.
100 ka 40%, 40 they are paying the tax. In this case, because the total earning is 110, so 110 times 40%, 44 they are paying the tax. Profit after tax in this case 60, in this case 66. Here if you see, actually it's look like 10 they are paying the interest, but the difference between both the earning is how much? 6 only, correct?
Yeah.
60 and 6. It means I can say, and what is the difference? Due to what reason there is difference? So due to reason is the company A has the loan whereas company B don't have the loan. So can I say cost of debt is nothing else 6?
No, you can't.
That would be so this is only the formula. Now only I will share. Even though your professors see, they have not explained you, they have given you, they have directly given you the formula. If you see, interest 1 minus tax rate, so this the formula they have teach you. Or generally if the amount received 100 or in percentage of money it would be, so that's they have received. So generally they are saying the formula we will use for cost of debt is, we have what we have discussed, if no tax, interest divided by amount received. Because in case of most of the company there would be tax applicable, so due to this 10 you are here getting 4 benefit, $4 benefit. See, if company is not taking loan, they need to pay extra 4 rupees
Mm.
tax. So that's why we say tax benefit you will get if you use the debt. So that's why the cost of debt formula to be calculated, it would be in this way. Interest times 1 minus tax divided by amount received. If suppose amount received is not always changing, generally it could change, then it would be interest 1 minus tax, and tax in percentage form. Interest also in percentage form. This would be the formula.
Perfect.
So we are discussing now a terminology I'm mentioning. We are discussing the debt which is irredeemable. What is meaning of irredeemable? It means a debt always be continue. You are not going to repay the principal. See, irredeemable means what I have mentioned, I'm repeating once more. They will not repay back. It means always you have taken suppose 1 million loan, it will continue to infinity period. The company is not going to return 1 million amount. Instead of they will always pay the loan. So that type of debt we say irredeemable debt, and in this case the formula would be this. Okay.
So if we have a bond, we use that formula.
Yeah. If no, there is two type of formula. If they are not saying when they will repay the bond. Okay. Repayment is not mentioned. Repayment not mentioned. Okay. In that case, this formula would be there. If it is mentioned, company will repay the loan after 10 years, we will discuss that formula. So these two formula we need to discuss, and these two formula even your professor has been used. I'm using same thing. Okay.
Perfect.
So up to here we are good.
Yeah.
We'll do one question. See, the same thing it is used by your professor. I have just used it for your reference, so you don't get confused. Okay. Same thing we have discussed. Interest rate 1 minus tax. Okay.
Perfect.
So X Limited issue 8% debenture at par, tax rate applicable on the company 50%. Cost of debt. What is cost of debt? Could you apply the formula? The formula is interest 1 minus
Tax.
tax. Could you let me know? So cost of debt always
Yeah.
be in the form of percentage. Yeah, tell me.
Yeah. I'm just looking for the percentage. It would be 46,000.
No, so here we will calculate in percentage form. Okay, I will help you first. Okay, so what I have told, interest, it's not like even though you will calculate in full amount, you will get same answer. So there is two option. See, interest, whenever the anything percentage, so here what would be firstly the interest? Could you tell me what is the interest rate? Firstly, what is the interest?
Interest is 50,000.
No. 50,000 is total loan amount.
Oh,
Loan is 50,000 and interest. See, this percentage is always interest. It means
oh,
always, so interest is 8%. That's why I have asked this question, because I aware sometimes people get confused about it. Generally, whenever the percentage will come, you need to write in 8%. We write like 8 by 100, correct? Can I say
yeah,
8% is 0.08?
yeah.
Correct. Then option 1 is interest and then tax rate. Could you tell me?
Sorry, can you repeat?
Tax rate. Tax rate.
50.
Yeah, 50%. Okay, so 50% is correct. It is mentioned. See, very important the percentage. Can I say 50 by 100?
Yeah,
And then it would be 0.5.
0.5.
Correct.
Mm.
So it now could you calculate quickly? Shall I help you?
No, no, I'm trying to solve it. 5. 1 over 25.
No, 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 no. So I will. So here I
Yeah,
will
I think
show
I need
it
help.
again. Yeah, 0.08 times multiply 1 minus tax rate. Tax is 0.5. So it would be 0.04. 4% or we can say 4%. Do you got how we calculated? So formula interest into 1 minus tax. Interest is 0.08. 1
I
minus 0.5.
I wrote down the same thing, but it gave me like a not a decimal. It gave me like 1 over
Not
25.
possible. Not possible. So
I
shall I
think
show
it's
you
from the calculator.
calculator?
Yeah.
Calculator have the issue. I will show you my calculator 1 second.
Okay.
In here we will see it. See,
There is a way to make it a decimal, but I don't know.
0
So
point. Which calculator you are using?
uh, class wise, I think
Okay, you can
Casio.
send me with a pic. Otherwise, I will suggest one calculator to you. It's very important, and you don't
Mm.
need to use the Excel. It's not allowable to use Excel.
Yeah, it's allowed. He told us today.
Okay, then it is perfect. Okay, anyhow, I will show it here. Firstly, 0 point. I have put decimal here. Then 0.8 times. Can I do
Open
zero
the
point
bracket.
zero 0.05? Zero. See,
No, you have
one.
to put it in the
Yeah,
bracket,
but
right?
generally what happen, see, whenever bracket it is coming, you need to solve this first. It
Mhm.
means, so it might be possible you are doing the same mistake. So if bracket it coming, it means firstly you need to solve 1 minus 0.5 would be how much?